All right, thanks folks. For those of you who have already jumped on the call and are joining us here today, super excited to have you all. So yeah, this is a new series that we've decided to start here at Supermove. It is the 101 series. So we got a lot of feedback from folks who really want us to take a little bit of a deeper dive into different topics. And one of those topics that came up was really around financial literacy. And a lot of the other webinars and roundtable sessions that we've had, folks have been, keen to learn more. Because one of the themes has been like really knowing your business and knowing the numbers inside and out as a great lever for really being able to grow your business, cut down on costs, and all of the other things that are required for owners and operators of moving companies. My name is Travis Wingate. I am the Vice President of Marketing here at Supermove, and I'm super excited to be joined by Dave Finger. I'm going to hit pause on that and let him introduce himself in a second because he'll probably do it far better than I will. But in terms of just some housekeeping items, feel free to ask questions in the Q&A section. So in your Zoom chat window, you will see that there is a Q&A tab there. Drop your question in. We're going to try to get to all of those questions live during the session today. If we can't, we will be doing a follow-up blog as well as a follow-up piece of content around this where we will try to answer those questions there. But please feel free. It's going to be far more interesting if you folks pose questions for Dave to answer. We will also be sending out this webinar recording later in the week, along with the recap blog. So you'll be able to take a look. There's also a resource that Dave's going to be taking us through today that will also be shared with you folks. And then lastly, if you're interested in participating in a webinar, roundtable, or have content ideas, please feel free to reach out to me directly, travis@supermove.com. And so with that, I am going to go ahead and turn it over to Dave. I'll let you do an intro and then I'll queue up the PowerPoint presentation. So why don't you tell us a little bit about yourself and how you got into the world of moving?
Yeah, thanks, Travis. So just kind of high level, started out in public accounting many years ago. And my first job after public accounting was working for a moving and storage company, rather large. For the time, I guess, large moving and storage company, United Van Lines agent, and spent a good number of years there before I got into outsourcing. And that's been kind of my bread and butter here, just kind of, financial literacy, I think, for my whole life, my whole career. I mean, I helped educate our owners, the owners' children in terms of financials, things like that. I mean, very hardworking group, but kind of like many moving and storage companies. I think the owners, they know moving and storage, but they, they come to it with a little bit more of a blue collar mentality, hardworking mentality, and don't necessarily come to it with from the standpoint of looking at financial statements and what they actually mean. It actually kind of reminds me of a story when I first came to the moving company that I worked for. The owner and I went down to a seminar that United Van Lines put on. Something like this actually was a financial literacy seminar. And the first thing that the person did that was hosting the seminar is he asked a question. They said, how many of you as business owners, look to your financial person and basically just want them to hand you the financial statement at the end of the month and say, how did we do, up or down, right? And, good number of people raised their hands and they said, okay, well, one of the comments from one of the owners, because the financial statement was in the black or was in the red. He said, well, I guess I got to go load more trucks, right? And, this person stopped us on a dime and said, well, what if every move you did, you were losing money on? Would it help to load more trucks? And it just kind of everybody at the time just kind of took a step back and paused and was like, yeah. Wouldn't seem to make sense to load a whole lot more trucks if you're losing money on every job, if your financial structure was set up where you were not making money on what you were doing. So that's really why, I wanted to jump in with you with this seminar on financial literacy, because I think there is a lot of things that you can learn and take away from your financial statements on a monthly basis.
Yeah, absolutely. That's awesome. I love that as well, because it's not just about the growth. It's, well, how much is it costing you to grow? And I know we're going to get into that as well. So thanks again for joining us. So I'm going to go ahead and turn it on over to you. I'm going to queue up, make sure I got it ready to go, your presentation, and then we'll take it. I'll let you take it from there. And again, folks, please drop your questions in the Q&A if you have anything that you want to ask of Dave. All right. You folks seeing the Dave, is it showing up for you?
Yep. Looks good.
Okay. Awesome.
Yep. All right, you can flip through to the next one there, Travis. Yep. Okay. Icebreaker. I kind of like this question because it kind of sets up what we're going to talk about a little bit. But is $1 of cost saved the same as $1 of revenue generated? Maybe we can get some responses here in the chat box. But this is kind of one of these where, hey, is $1 a dollar, right? I mean, so if I save $1 in cost, or I generate more in revenue, it's like, what's the mentality, right? What are we thinking about? Everybody wants to increase sales, right? But what's going to have a quicker effect on your bottom line, right? If you increase sales, you have costs associated with that. You have fuel, you have cost of labor, you have costs. So $1 of revenue is not the same as $1 of cost generated. That's generally going to go all the way to the bottom line, right? So again, important distinction between revenue and cost. And I know it's kind of a softball, but some people get tripped up on this, believe it or not. So.
Well,
all right, you can go ahead.
Given where we're at right now, and particularly in the software industry, specifically, it's, for the longest time, especially during COVID, it was grow at all costs, growth at all costs. That was the mentality. And now that mentality has shifted, given the current economic times and the uncertainty. It's like, well, efficiency at all costs. And so that is a shift in how you think. That is a shift in where you focus your resources. And I think it's just a really great call out here of like, how can you possibly answer this question if you don't have a solid understanding of your finances and have that literacy to really be able to understand how these two things are different? So it's a great point.
And I think just to finish that point up, I did have an owner, one of my mentors here too, that in the moving and storage industry, and one of his favorite comments, one of his lines all the time was, "So you mean I can make $1 without turning a tire, right?" So you think about that. If you can make $1 without turning a tire, what does that save, right? Every time you turn a tire, you got risk going down the road, right? I mean, there's insurance risk, there's the risk of you're going to fail on the move for some reason or another. But if you can save that cost and make money without turning a tire, just kind of think about that mentality. That's super important.
Yeah, absolutely. Awesome.
Okay. Starting from the beginning here, kind of, why is accounting important, right? Or more specifically, the primary, accounting function, financial statements and the underlying data. We got to think a little bit about who are the users of our company's financial statements, right? What are the uses of the financial information of a company, right? They're used in a lot of different ways. And why is it important to have accurate and timely prepared financial statements and related information? I mean, so you think about that and what you want to get out of your financials as you go through the week, go through the month to month, year to year, comparing to previous years, the information that you can learn, right? So Travis, maybe you just advance us here to the next slide where we got some answers here. Owners and investors, right? They want to be able to value the business. So that's kind of very important. That's information you can get from the financial statements. Whether you're going to sell your business, whether you're also going to the bank, you can see on your banks, equipment companies, finance companies, other creditors, right? They want to know that your financial statements are accurate. They want to know that they can count on them. They want to know that they can believe on them. Yes, some companies are big enough to have an audit or review of their financial statements by external CPAs, but a lot of smaller mid-sized companies can't afford to do that, and that's not part of their banking arrangement, right? So you want to make sure your accounting information is accurate, set up accurately. Maybe the most important thing, and I kind of alluded to that already, is just management. The financial statements guide their decisions, right? Can we afford to buy a new truck? Should we, do we need to cut staff? Do we need to hire? Do we need to put more emphasis on sales? A lot of times, in this, when you get into tough environments and some companies are failing, a lot of times it's a great time to buy, right? I mean, you can get equipment for less. You can do an asset sale of a company or asset purchase of a company. So all those things. Then, of course, you get your government reporting for taxes and licensing. And then one of the things we're going to get to in this webinar here, the key performance indicators. I mean, so what are your key performance indicators for your particular business? They're not the same for every business. We're going to kind of go through high level on some of these and what they are. But those are all great things that you can get out of your financial statements.
And maybe we'll get into this, and if so, just we can pass on the question for now. But how often, as an owner, as an operator, are you looking at the financial statements? Are you looking at this information? Is it like, is there an ideal cadence for someone to be looking at this info?
Well, a lot of in today's world, and I think even with Supermove software, right? I mean, you've got real-time information, right? That can be downloaded in QuickBooks Online, things like that. But in a lot of respects, that information isn't complete until the end of the month. So I would say generally on a monthly basis, there are some key indicators you can take away probably weekly, or maybe a dashboard that you can look at daily and see how your sales are going or how things like that. But for the most part, on a overall financial statement basis, I would say monthly is kind of the one sit down. There are companies that can get away with it quarterly, but I would advocate primarily for a monthly review of the financials.
Right. And I know we are going to get into a second, just the different, like a controller versus, the accountant versus someone who is the owner of the company. Maybe their cadence is a little bit different, because the folks who are actually like in the day-to-day weeds, there are things they probably should be looking at on a daily basis. Whereas in terms of looking at the total financial health, maybe it is a month, maybe it's a quarter at most. Yeah. Awesome.
Absolutely. Okay. So what are the main components of a financial statement? Balance sheet, right? Shows your assets, liabilities, and equity. You got two sides generally to a balance sheet, your left side and your right side, or one page, page one, page two. Assets are generally on the left side, and then who owns those assets? It's either your creditors or your owners. So, accounting 101 right here, right off the bat. Assets on the left side, those assets are owned by somebody, either your creditors, you have loans, you have accounts payable to your vendors. The remainder is equity owned by the owner. So that's what you see on the balance sheet. Income statement is your revenues minus your expenses, or your net income for the period. A couple of interesting things there is you normally have operating activities, which come first, your operating revenues less your operating expenses. And you have other expenses, right? It's things that maybe are non-recurring. Maybe you have a casualty loss, right? Okay, so you don't want to put that up in your operating income, because maybe the bank says, gee, overall they're doing really good, but maybe they lost money this year because they had a casualty loss, so it's non-recurring. That type of stuff normally goes below the line. Okay, so again, very important there. You want to present yourself to a bank or equipment finance company in the best possible light. So categorizing those things as operating income versus non-operating or non-recurring income and expense, very important. And then cash flow statement, right? Okay, everybody's heard that term, cash is king, right? So on an income statement, you don't necessarily know, that doesn't tell you necessarily what happened to your cash. Every business needs cash to operate. So a cash flow statement will take the net income, and then it will go from there, and it will explain what's happened to versus operating activities, financing activities, and investing activities. It'll kind of divide up into those three areas. So again, and then you have statement of shareholders' equity. Sometimes the financials, depending on how big you are, you either come with a statement of shareholders' equity or not. This is basically going to tell you if there's a distribution. Maybe it's important to the banks to know that they have distributions that are being sent out to the shareholders of the company. They want to know that kind of detail. And then finally, your notes to financial statements. Again, if you're doing it monthly, you're probably not going to have notes to the financials, but on an annual basis, the accounting team, CFO, should put together notes to the financial statements that explain the accounting policies, details of the debt that the company has, any extraordinary items that are on the financial statements or need more explanation, end up in the notes to the financial statements.
And maybe this is, and maybe the answer is almost like, no, you got to look at all of them. But, new moving company starting out, or a moving company that's maybe smaller on just getting going, like, is there something that's probably more important for them to start with, or really for them most important to understand in terms of, is it the balance sheet? Is it the income statement? Or is it cash flow? Like cash flow is something to me that would kind of make sense, that you should probably definitely have your finger on the pulse there, because it is the livelihood of your business. But is there kind of a recommendation of where, like, you really need to start here if you're a small business, versus if you're more of an enterprise, you probably need to be looking at all of these?
Sure. Well, I think cash flow statement from, like you said, if you're a small business, It's probably the hardest statement to put together, but it's
Mm,
probably the most important statement, right? You can't run your company aground, right? I mean, it needs cash to operate. And so from that cash flow statement, you can also do, forecasting. So you can kind of look ahead 1 month, 3 months, 6 months. Okay, am I going to have enough cash to keep going here? And it's those forecasting type things, very important, especially when you're a startup company, to know if you're going to be able to make it through, right? Or do we need to do something different to get at some more financing? As you grow a little bit and your cash flow stabilizes, then I think it shifts more to the income statement, because there you get everything in the right buckets, right? Income for the period, your revenue for the period, your expenses for the period. They're not always lined up with cash, right? Sometimes you have to pay things early because you're a startup and vendors aren't going to work with you unless they get the cash paid in advance. But that doesn't mean you expense it then, right? So income statement is going to tell you, am I making money over this period of time, whether it's 3 months, 6 months, a year, a month. Again, very important. And then I think even you think about a more mature company, the balance sheet, super important, right? In the sense that, am I building equity, right? Am I building equity for my future? Am I building equity that I can sell, that I can pass on to my children? Okay, so life cycle, I mean, they're all important at various stages of time, but I think early on, startup stage, cash flow, super important. Growing mid-sized business, income statement, and then balance sheet as you think about the mature, that's what gets the focus as your business matures.
right. No, that's really tangible and helpful advice. Like the life cycle of the company is probably married very closely with when you should be looking at these statements and at what level.
Mm-hmm. Okay, so I pulled out a sample. This is a public company. We whited out the name, but we've got the financials here, and I don't know, Travis, it's a little small for me. I don't know if you can increase the size, but it's not necessarily the numbers that are important here. I mean, we'll kind of get to that.
Okay.
But again,
Yeah,
just
'cause
wanted
it's
to give
in
everybody.
print mode. I don't think I can increase the size, but are you good? Can you see what you need to see?
Yeah, well, we can work with it here.
Okay.
So we've got a balance sheet right off the top here, and so you can see one of the things that the total assets equal the total debt and equity, right? So, and then the balance sheet is divided into two different areas here: current assets, non-current assets, other assets, right? Okay, so current assets, that total number right there, not the total assets, but the total current assets, very important, right? What makes something a current asset is an asset that will be able to be converted into cash within 1 year, right? Okay, so whether it is cash now or marketable securities or receivables, okay, you've got prepaid expenses that were cash that you paid to maybe prepaid insurance or something like that, of that nature, that's going to be used within the next year, okay, or can be used or used within the next year. That's the definition of a current asset. Very important, because you also have current liabilities, right? So this particular company has almost a 2-to-1 ratio of current assets to current liabilities. So what does that tell a bank, right? That tells a bank that it's got a whole lot of coverage, that this company is going to be solvent for the next year, right? I mean, because they have got more than enough current assets, almost double, to pay off their current liabilities. Okay, so very important. That's a ratio. It's called the current ratio. We're going to get into that in terms of what banks and finance companies look at. So if your financial statements are not set up like this, you want to get them set up like this. Okay, again, it enhances, brings to the bank the financing piece of it. Hey, it highlights to them what it is that's important, what it is that you're gonna be able to demonstrate easily that you are a solvent company and able to get a loan. Okay, and again, just looking at it from the banking perspective, but also from an owner, just on a monthly perspective, you're like, yep, we're in good shape. We know we're gonna have enough cash. We're not gonna run the company aground. When especially at a 2-to-1 ratio, most companies don't have that luxury. I usually see them somewhere, 1.2, 1.3 ratio, something like that. We'll kind of get into that. But again, if you had a 2-to-1 ratio, you'd be really good here. Then you also have non-current assets, your fixed assets, land, building, transportation equipment, less your accumulated depreciation. It all nets down to your total assets. Your liability side, again, your current accounts payable, other current liabilities, which are going to be generally loan payments, the current portion of the loan payment that's due within 1 year. And then you have your long-term liabilities. So usually the remainder of the loans that are due or payable outside of a year. And again, you have your total equity, total liabilities and equity that should equal your total assets then.
Yeah, it's as you're going through this, I am not a finance person. I'm a marketing person. And oftentimes marketing people and finance people go head to head. But it's interesting because as you were able to really get to a quick point of like, they have runway, they have, 2 times the assets that they need. And so I have to imagine that whilst this isn't an easy type of document to put together, it's feeding in from tons of data sources, I would imagine. It does help the company and probably the owners, the operators, the people that really do just want someone to tell them quickly, yeah, we're good. Here's the number that says we're good. That's the beauty of this, right? And then if you need to, you can drill down.
Yeah. So you mentioned that this isn't always an easy document to put together, but with today's software, with Supermove, with pairing that with a QBO or another high level software, most of that information feeds right in. You can get your bank feeds coming right from the bank to reconcile these things. The time to complete a financial statement is getting reduced all the time. And the difficulty once it's set up is being reduced all the time as well. Right. I mean, so it's, all that's been very positive with the advent of, online softwares and things like that. And, and Supermove is at, from what I've seen is really at the front of the line when it comes to that. And so it just makes it very easy to work with to get your data into a QBO or other, I'm sorry, other financial software.
Right, exactly. That's one of the great things about the Supermove platform is the fact that it does integrate with the different, within accounting software such as QuickBooks, which is really exciting. Okay, what about this one?
Yep. Then we go to the income statement. And again, here I kind of alluded this a little bit. You start out, you have operating revenue at the top, you have your operating expenses then, and so you have your income from operations. Super, good number. You need to have that number, right? I mean, because so many other things happen, the other income and expense that are non-operational type things. And so when you look at preparing, break even type analysis, right? I mean, how much revenue do I need to cover my fixed costs? How much, type thing. So to have all of this set up, there are some companies and there is a case to be made for taking your operating expenses and dividing them into variable and fixed, right? So a variable would be your fuel, your labor to complete a move, things like that. Things that expenses that you wouldn't have if you weren't operating. And then you have your fixed costs, right? So a lot of times you'll see a contribution margin that comes in operating revenues. You have a contribution margin after your variable cost. Then you have your fixed costs. Then you have your operating income. Okay. These statements aren't divided up that way. I would personally like to see the variable operating expenses because then I know, right? I know exactly how much I need in terms of revenue that I can generate, right? Let's say I just generate 50% above my variable cost on every move, right? Let's pick a round number there. I can easily tell how much revenue I need to cover my fixed costs and then my other income and expense like interest expense and things like that. So again, that's kind of an important number. Again, highlighting when you get down below, you got your other income and expense, interest income, interest expense, other extraordinary items that maybe a gain or loss on the sale of fixed assets of your trucks, things like that. All this stuff that's non-recurring goes down below. The other thing you'll notice about this, it's nice to see that a comparison to the previous year a lot of times to go, hey, are we making progress? Are we going backwards? What's going on year to year comparison? Some companies can even, we'll put out more than 1 year comparison going back. So they have kind of a history, 3 to 5 year history. Always nice to see in terms of if you're making progress, we're going up, we're going down, are we making the right decisions? Are the financial statements acting in the way that we expect them to act?
Right. Well, and that's an interesting point too, right? Because there is seasonality obviously within the business. And so that's another great way to say, well, what happened this time last year? in the company. And like, you can, again, better forecast, better plan, really understand what levers you need to pull so that you can have a more successful year, perhaps than you did the last year, or you can build upon the success that you had of last year. Now, is this the statement, going back to your icebreaker question of growth versus cost? Presumably, like, I'm assuming this is where I would go say, okay, my operating expenses, if my operating expenses are more than what I'm generating in terms of the revenue, then just doing more moves is not going to be the answer. So this is the place I would go to kind of cover that.
Yeah, this is where you're going to see that, right? Okay, so again, and the other way to think about it too is generally, right, your operating income is positive. That's not where you see that. I mean, if owners know if they're making money generally on a per move basis, okay, but a lot of times the question becomes, when it's super competitive, maybe the economy slows down and the rates go down then because it's more competitive. How low can we go on our rates, right? I mean, how low can we go on our rates and still make money, right? I mean, so that's really where it's important to know. I mean, so yeah, it's great to know. I mean, if year over year you're making money, it's going up. I mean, and you're getting all the moves you need. But a lot of times the most important question comes in and just, how close can we be? How close can we cut it if we need to and still make money? I mean, that's really where you want to be, because you don't want to get into that. If you're not covering your variable costs on a move, you're better off parking your equipment, literally. I mean, because if you're going to lose it every time, you're unless you can make $1 more over your variable cost to contribute to your fixed cost, you are not, you really should not be running your equipment down the road.
Right. And I think that's what's, sure, it's finance, and so it's a little dry, sure, but I find it incredibly exciting because it's knowing that, it's having that information, and it's all here to be able to say, okay, what is our strategic direction that we want to go? What are the levers that we have to pull? And you really can only do that in an educated or knowledgeable way if you have access to this information. If you have access to the information and you understand how to interpret the data to make those decisions, which is, where having a controller or CFO or outsourcing that can be a huge advantage. And I know we'll get into that in a little bit in a second.
Yeah, I mean, think about it. So when marketing, when you talk about it being a little bit dry, like you say, but look at the guidance you can give your sales and marketing people, right? Okay, it's like, hey, if we have to, we can lower our cost of this, right? I mean, we don't want to, our goals are up here, right? But maybe we need to get into this account, or we want to get into this account because they're going to give us a try, right? But we got to trim things up a little bit in order to get there. Well, you can tell exactly where you need to trim it to, I mean, in order to and be able to make that decision there. So, but again, that only comes with timely financial information here in this kind of format.
Exactly. And I think it also then allows you to say, okay, yes, we want to get in on this account because in a year, we raise our prices, we increase, we do X, Y, Z. Then it gives us the visibility as well to know, okay, when does it become profitable for us? So it's not just about being profitable today, it's about when does it actually become profitable for us? Because in some instances, you may take a haircut on it up front, knowing that long term, it's going to be a really great move for you to make as a company.
Yep, absolutely. All right, cash flow statement. Yep. So kind of as promised, right? We start with net income at the top. So if you look back, Travis, to the previous page, what was our net income? If we just flip back, our net income, 271.
271.
Right. And so what do we start with here on the next page? 271, right? So we're gonna work down from there. And this, again, it goes in a certain order because we want to find out if you can see net cash provided by operating activities, right? So that's what's important here. So you take our net income and you're like, again, a lot of people might say, hey, we had net income, we made money, or we were positive cash flow, right? Well, were you? So a lot of things happen. So operating activities, right? So you might start a new account and they're like, yeah, we'll work with you guys, but we're not going to pay you until 90 days out. Okay, so what does that do to your cash, right? That's a drag on cash, right? Because the receivable is going out, okay? So you're going to see a decrease in cash whenever your receivables increase. Consequently, your payables, right? So again, if you pay your payables down, that's going to decrease cash. But if you work out with your vendors and go, hey, I need a little bit more time, I can work this, that's going to increase your cash. So again, some things that happen on the balance sheet, okay, affecting what's happening to cash here. So again, how you manage that is going to affect your cash flow up or down. Okay, after your operating activities, then we get to investing activities. Okay, so did we buy a new truck? If you bought a new truck, that's going to decrease your cash. If you got a loan though, that's going to increase your cash, right? So we're gonna so that's where the investing activities, actually we get into financing activities. That's where the loan piece of it comes in. So all of these types of things over here that and I'm having a little bit of a hard time reading those, Travis. Maybe you read what's under the investing activities, like purchase of equipment and
purchase of transportation equipment, other property and equipment, proceeds from
proceeds from sales.
Off lease inventory, marketable securities.
Yep. So that's what's, those are your investing activities. And again, and that increases cash or decreases cash. So then we get to the financing activities, proceeds of debt. Okay. That increases your cash, dividends paid. Okay. Those, if you have to pay dividends to your shareholders, that's going to decrease your cash. So again, all of these things, you put them all together and there's a beginning of period cash, end of period cash. And then again, that's what a cash flow does. What happened to my cash during the period?
And do you think there's a section of this that is like incredibly relevant for like movers right now, like especially like maybe again, like if we use kind of the small business as the example, I would imagine, and correct me please if I'm wrong here, is like the receivables and the payables. Like you can play with those quite a bit to say like, okay, well, what are you going to pay out? But also like, what are our terms on when we actually receive the cash? Because would that have the most short-term impact on the business? Is that a great area to focus, or is there somewhere else on this that you would suggest they look for?
Normally this first section of the cash flow statement, the operating activities, is the one that, this is what's happening on a daily basis, right? I mean, if you want more cash, collect your receivables, right? Not always easy to do because you have those customers that, we're only going to pay 75 days or whatever. And if you decide that you're going to live with that, that's fine. But what I've seen through the years is receivable collection activity is the thing that gets the most neglected in an accounting and finance department. You really need to make sure you stay on top of that, because that can your cash can erode quickly when it's sitting there in your receivables, right? And at some point it's going to get to be non-collectible if you have people that are just going to constantly stringing you out. So if you want to be a better business manager, put time and emphasis into collecting your receivables. It's that important. Companies that you're working with generally know that too. And you can work through with them with a good, receivable collections person to just say, hey, we know we're probably not going to get this all at once, but let's make progress week to week, month to month, those types of things. Work out some arrangements with your customers, let them know that you're in business too. And you got to have cash to survive, and they'll understand that. And if they don't, maybe you don't want to be working with some of those customers. Again, on the vendor side too, it's okay to push them a bit. They're doing some good things for you, but they gotta, they have to want to work with you, and if they can help you out a bit, extend things a little, that's just the way that it is. So day to day, week to week, that's where the business owner can make the most impact, is in the operating activities and the cash flow statement. Investing activities though too, here it is, in terms of between this and in conjunction with the financing, hey, can we afford to pay for this with cash, or do we need to go out and get a loan, right? I mean, those decisions go hand in hand. Or maybe we have excess equipment here, maybe we're seeing a little bit of a downturn. Now is the time to sell it, increase our cash, put a little away for the rainy day. All of these decisions, those things all show up here in the cash flow statement.
Yeah, and you were on a previous webinar roundtable that we did, and that was one of the points of prepare for a recession. Like if you have equipment that you're not using, maybe it's time to actually consider selling it, right? Because for the purposes of cash flow, and so we would see that reflected here.
Yep.
Awesome.
Absolutely. Yep. Okay, so KPIs here, or these are financial ratios. these are relevant to really any different business, right? You get your profitability ratios, asset turnover ratio, liquidity, capital structure. You don't have to focus on all of these, right? But if there's certain ones that are super important, right? Your operating income, operating margin, again, I would not look at net income margin, net sales necessarily and worry too much about it, because it can be affected by a lot of non-recurring type things. But operating margin, very important, right? The other thing that you want to look at, your liquidity ratios, right? Your current ratios. We were talking a little bit about that here. This particular company, 2.03 in their current ratio. Again, that's going to be super important to a bank. They're going to be able to look at those. So if I had to pick out one in each category, it would be your operating income margin here, your current ratio over there, capital structure, debt to equity, again, a super important one for the bank.
Right.
They're not going to want, this company's got very low debt, right? I mean, but if you get your debt to equity ratio kind of above 3-to-1, where you got maybe 3 times plus more debt than equity, that's going to start to make a bank a little bit nervous. So again, those are some areas that you really want to focus on if you want to. I mean, again, sometimes it's analysis paralysis too, right? I mean, focus
Right.
on the ratios that you really need to manage your business. And if I had to pick those are the ones that I gravitate to. I also look, we're kind of talking about accounts receivable, right? Your accounts receivable turnover. So, or days sales in AR, right? So this company's got 44.14 days in accounts receivable. If they were able to reduce this to like 40, what it does, it makes a tremendous impact. Okay. So every receivable that you collect on time or sooner than you have been reduces that AR turnover. You want to get that number down. Ideally, 30 days or less would be great. So if I had to say that, an issue that this company could focus on, it would be this one right here. Again, to put more into their collection activity. 44.14, a little high, not super high, but a little on the high side. And again, I don't know how most of their contracts are set up, but that is an area that I would definitely try and keep as low as it can.
Right. Yeah. $1 today is better than $1 tomorrow.
Yep, absolutely.
For sure. And so are there, or is there a resource, or are there like industry standards, or so you're saying like 3-to-1, 2-to-1 for different ratios? Are there, is there something that folks can look at, and we can always send it out after if that's the case?
Well,
Like, this
I mean,
where you want to be, or is it very
it
dependent on
really
where the
varies. It
company's at?
varies bank to bank. It varies based on
Sure.
your overall financial position. I mean, that's just been my experience through the years and kind of what I've seen and where banks have kind of, where they, and a lot of my thinking is geared, right? I've worked with small to medium-sized companies, not so much the super big companies that can do a lot, move money a little bit easier. So my focus always goes to the bank and
Right.
what it takes to keep the bank happy, what it takes to keep you solvent as a company, things that you can focus on, and that's where I'm kind of coming from in terms of giving you the numbers that I would focus on and what's important to them. But that also is obviously important to the business owner, the small business owner, medium-sized business owner as well.
Right. Yeah, that's super helpful. Okay.
So kind of just getting back, we had this slide up before, users and uses of financial information. We're going to get into key performance indicators here a little bit. Again, so you had the financial statement ones that we went through. Now we're going to look at some other ratios for a trucking company. And these financial statements come from a trucking company. So, there's going to be other things that are important specifically to a moving company, but not necessarily, right? Okay, so, you look at the profitability, liquidity, asset turnover, we just talked about those, but then industry specific, okay, revenue per mile. You can have revenue per move, revenue, fuel per mile that you had in your moves, right? Driver wages, per day. A lot of times, what I've seen in a smaller moving company, what are my costs? If I had to add it all up, what are my costs per day, right? What are my costs per hour? Okay, how much do I have to generate as a company to be ahead of that, right? I mean, so again, it gives your salespeople something to shoot for. It lets you know if you need to make changes to your overhead structure. Maybe you need to let somebody go. Maybe you need to find other ways to decrease costs. Those types of things are super important again for a moving company, um, when they're building out their rates and their cost structure.
And it's the KPI piece, at least how from a marketing perspective, how I use KPIs is because oftentimes like revenue and how you're going to finish the quarter, that's very much a lagging indicator. Whereas like a KPI on the other hand, and really looking at the day in and your fuel per mile and saying if you're moving the needle on that one, kind of those are leading indicators that tell you how the quarter, how the month may be shaping up, right? And so these are probably for the folks who are kind of operating it day in, day out. These are some of the financial KPIs that they should be looking at. Is that fair?
Absolutely. And those are the things you can put on a dashboard with, your Supermove software too, because that information is coming in real time, right? I mean, as soon as you turn it over, as soon as the move's completed, right? Miles, rates, fuel, you can get all of that information and you can put that on a dashboard and look at that, daily, weekly, monthly. How's it changing? How are we doing? Right.
Yeah, absolutely. And the trending data, that's huge. Like being able to say, like, are you getting better? Absolutely.
Yeah. So here you can get into some more of these. And again, some of these are related specifically to trucking companies, not necessarily moving companies, but again, you can look at, what's important to my business. I mean, every moving company is set up a little bit different too. A lot of them are set up more like a trucking company that, in terms of the moves and their warehouse operations, things like that. But you look at all these different percentages, revenue, your brokerage percentage. A lot of moving companies that I've worked with have a brokerage, right? They'll broker out moves. They'll do, electronics moves for companies, things like that. What's your percentage there? Your revenue per driver, or per, lead mover, or revenue per, your loads, moves per week. Maintenance expense, right? I mean, are we doing our own maintenance or are we hiring it out? Can we, save costs by doing it one way or another? So again, you have to kind of look at where your pinch points are and what's important to you as a business owner and come up with those key performance indicators. And again, it's not necessarily doing them all, right? It's doing the ones that are key to what you're doing. Okay. Every company is going to be different. What is it that you need to measure? If it's not measured, it's not improved, right? I mean, that's kind of the old saying. And KPIs is just kind of we didn't call them KPIs back in the day. I guess somebody came up with this key performance indicator somewhere along the way, but it's important, right? I mean, they have to be, if it's not measured, it's not improved. So
yeah, and I love your point of like you don't have to measure it all. And because I think it's so important, because if you try to measure everything and you try to focus on everything, you're probably going to end up focusing on nothing, right? And so like what matters most to you, given where you're at in your point. And again, that's where someone, if you hire a company, an agency, a fractional CFO can really help pinpoint, those key areas of focus depending on your business and where you're at.
Yep, exactly. Yeah. So, and Travis, thanks for for inviting me on here today. I do have want to talk a little bit, if it's okay here, about CLA and what we do here in the outsourcing world. I kind of alluded to that before, in terms of how do you make money without turning a tire, right? I mean, how is your accounting set up, right? So one of the things that we do in outsourcing is a lot of companies, small to medium-sized companies, they can't afford to have a full-time controller or CFO, right? But a lot of times they need to have that service, right? They need to have somebody that understands the financials. Okay. CLA used to be a small regional accounting firm. Now they're the 10th largest accounting firm in the country, and most of that growth, just about all of it, has been through the outsourcing sphere. It hasn't been audit, it hasn't been tax, it hasn't been consulting. It's through this outsourcing, because there's such a need out there for companies that, again, can't afford a full-time CFO or controller, or again, if you're looking at, maybe my controller's retiring, or, am I getting the value out of that controller? I mean, what we normally find is that 70% of what a controller does on a daily basis can usually be pushed down to lower level staff, staff that maybe is not experienced in accounting. So we'll come in, do the higher level stuff, train your personnel to do the routine data process functions, to do some of the easier reconciliations, and we'll put a nice bow on it and make it, into the financial statements similar to what you've seen here today with all the KPIs and things like that. So management can make these good decisions, right? And it's like, yeah, I can, then it gives you an avenue to be able to function at a high level, financial statement wise, information wise, without having another full-time salary that you have to cover. And so that's kind of where, and Travis, if you can kind of flip through some of these slides here, and we'll kind of take a look at this. So you look at listing of capabilities, right? So green is what normally can be done by these levels. So a bookkeeper, staff accountant, right? They can do all the transactional processing, but can your bookkeeper, staff accountant do some of the monthly reconciliations? Yellow is maybe, red is generally no, right? Address complex accounting situations, prepare financials. Controller and CFO can do that. So if you flip to the next page, right? So again, your staff level accountant is generally not going to be able to identify these key metrics and take a look at these, or do some forecasting for the company, or trend and variance analysis. So again, a controller can generally do this, but not always, because sometimes you're in companies where the controller, used to be your head warehouse guy, and now Peter Principal, he's advanced to your controller because that's just, he had some aptitude in accounting, right? So CFOs can generally do all of this type of stuff, and right up to the top. So again, is your controller a good value? I'd ask all of you to think about that. And if not, there's definitely a way for you to save money without turning a tire by looking at a fractional controller and having them oversee what it is that you're doing. Be happy to talk to you about that. Our information's on here, but again, that's one of the reasons I wanted to partner with Supermove, and I think we've done that. We're able to help some companies. Supermove, great software, but companies don't always understand the back end part of it. Adding the QBO, or adding the, and we're an authorized reseller for QBO. We pass that through. We pass that through at cost from QBO. We get a 30% discount over the market rate. So, something to think about as an add-on to what you're doing with Supermove. Again, but we're happy to talk to anybody about that, to see where we could save your company money in this area.
Yeah, it's also by getting an expert to work on certain areas, then you can really focus on like actually running the business day to day, and the operations and the customer service, and making sure that that the company as a whole to the market is really appealing and really attractive, by letting folks who are experts in accounting and finance kind of run that in the back end for you.
Yep, exactly. Yeah, so here again, just some of the benefits of outsourcing. The hours can go up or down, right, as needed, right? So what we normally find is we're invited in. If everything's going great and you're making money, we don't normally get invited in. But when we get invited in, there's usually a problem, right? Things aren't going well. So we'll come in and we'll have a few more hours to start, and then we get it stabilized, and then we can start handing it back to you. And so then our hours start to reduce, right? And it kind of, so the model works that way. We stabilize it, we get it set up, we get all of your KPIs, all your financial statements, we kind of get that ready to go. And then, you have that person that maybe they have a 2-year technical college accounting degree, and they're just itching to take on more. Well, we can give that, so we can start to give things back to them. I want everybody to know that we're in this with you, right? Our job is, if we're going to, if we go in with a mindset that we're going to charge more and more hours, you're not going to be happy with us. We want to come in, get things stabilized, reduce that, get things put back to where they need to be for you, and make it so that you are seeing that cost savings out of your turning your accounting department from a fixed cost into a variable cost, essentially, right? So we can reduce those hours on a monthly basis. And again, push the work down to the lowest skill level of the person that's able to do it, right? That's the goal for any business. And then, so full-time CFOs, controllers are expensive, right? A lot of times a controller, CFO, they come in and they want to solve your problems for you, but maybe they want a deferred comp package along with their salary, and you're like, gee, I just want my accounting done. I don't want to share my business with everybody. So that's, again, where we come in with that partnership with you and with Supermove.
Nice. It's awesome.
So, yep. Travis will get all this information to you. For anybody, please feel free to reach out if you have any questions or like to talk. Be happy to do that at any time.
Yeah. So again, for folks, we will be sending out the deck for everyone, which will have all of these resources available, as well as all of the information that we reviewed in terms of the sample statements. Mm-hmm. So, well, thanks, Dave. That's awesome. It's kind of a little bit of a crash course today, but super, super helpful. No real questions have come through the Q&A yet, but I feel like I was peppering in quite a few during the session. So if you do have a question, feel free to drop it in quickly into the Q&A section. As a reminder, we will be, this was recorded, so we will be sending this out later in the week, along with a recap and all of the resources that were shared here today. Also, I know Dave is on LinkedIn, so feel free to reach out to him on there. But you can also contact him at dave.finger@claconnect.com. And yeah, we'll get this out to everyone. Any kind of final thoughts from you, Dave?
Yeah, we actually too are having CLA is having a Ask Us Anything CFO event, and then I am the national leader for the transportation logistics industry for CLA. So we are on my LinkedIn website. You'll find a place where you can sign up for a time, 20 minutes complimentary to ask us anything. Ask an experienced transportation logistics CFO. What your questions might be or what you're kind of hung up on, and we'll see if we can help you through that.
Yep, that's awesome. Great. Well, then with that, we're a few minutes early, which is perfect. So thanks again, Dave, for joining us. Thanks to everyone on the session. As always, feel free to email me, travis@supermove.com, with any questions, ideas, thoughts, you name it. Always here to listen. And yeah, we'll see everyone on the next session. So thanks, Dave. Thanks, everyone, for joining.
Thanks for having me.